All right, let's talk about the high-stakes world of eye care. Because in 2025, it was basically a heavyweight championship fight. You had four corporate titans going head-to-head, all vying for market supremacy. So the big question is, after 12 months of really fierce competition, who was left standing? Who took home the title belt? Let's dive in and find out who really won the year. And what are they all fighting for? Well, the prize is a staggering $37 billion global market. We're not just talking about selling contact lenses here. This is about dominating one of the most critical and fastest-growing sectors in all of healthcare. The stakes? They're absolutely immense.
So let's meet our main contenders. First up, you've got Alcon. They're kind of the undisputed heavyweight champ, a pure-play eye care powerhouse. Then you have Johnson & Johnson Vision, a really nimble challenger backed by a massive healthcare giant. And of course, there's the veteran, Bausch Lomb, a household name looking for a big comeback. And finally, the technician of the group, Carl Zeiss Meditech, known for its incredible precision and high-tech gear.
But, behind all these billions of dollars are, well, billions of patients. We're talking about very real conditions that affect people every single day. Things like cataracts, which can literally cause blindness. And presbyopia, that's the age-related focus thing that affects nearly 2 billion of us. So this battle of the titans, it directly impacts how the entire world sees. Okay, let's get to our first round, the weigh-in. This is where we just look at the raw financial power. Because in this industry, believe me, size, profitability, and just how efficiently you run your business, it matters a lot. And right out of the gate, you can see the scales just tip dramatically. With over $10 billion in revenue, Alcon is almost double the size of its closest competitors, J&J Vision and Bausch Lomb. I mean, that's not just a lead. That's a huge statement of dominance. It gives them incredible economies of scale.
But here's where it gets really telling. You have to look past that top-line revenue number. Alcon isn't just big, it's seriously profitable. Look at that healthy 13.2% operating margin. Now, contrast that with Bausch Lomb. Yeah, they have similar revenue to J&J, but their margin is razor thin at 2.2%. And look down at the bottom. They actually posted a loss per share of over $1. That signals some major underlying challenges.
So this all comes down to how efficiently these companies work. Financial analysts love these fancy terms like DSO turnover, but what does that actually mean for you and me? Well, it means Alcon turns a sale into cold, hard cash in just 58 days. Its rivals, they take an average of 87 days. Getting your money almost a whole month faster, that's a massive, massive competitive advantage. And that really brings us to the final word on the financials, and this comes straight from HDIN Research. They flat out call Alcon the industry's only all-around cash cow. For anyone investing, that's what you want to hear. It's a business that doesn't just make sales, it reliably prints cash. That makes it, without a doubt, the financial heavyweight. But hey, money isn't everything. Let's move on to round 2 and look at strategy and technology. This is all about what we call the moat. Those structural advantages that protect a company and keep all the rivals at bay. A huge part of that moat is something called switching costs. Think about it like this. Once a hospital invests, say, hundreds of thousands of dollars in a surgical system from Alcon or Zeiss, they're not just buying one machine. They're buying into an entire ecosystem. The specialized tools, the software, the training for their surgeons. So for them to switch to a different brand, it would be a nightmare. They'd have to retrain their whole team and buy all new gear. It's so much easier to just stick with what you know. And this just brilliantly shows the 3-layer moat that all these big players use. First, there's a huge wall of intellectual property. We're talking thousands of patents. Second is what the pros call ECP stickiness. ECP just stands for eye care professional. These companies build incredible loyalty by training surgeons on their equipment. And when a doctor has spent years mastering one system, they are not going to want to switch. And third, there's that equipment lock-in we just talked about, which creates a steady river of repeat purchases for years to come. Now, in 2025, Alcon landed what you could call a technical knockout punch with its PanOptix Pro intraocular lens. This is not just any lens. It's a premium, high-margin product that has advanced optics competitors really struggle to match. And in that part of the market where patients pay out of pocket for better vision, having the absolute best tech is a total game changer. Strategically, we're also seeing 2 totally different playbooks. You've got Alcon and Bausch Lomb, who are the patchers. They make deals to patch up and strengthen their main eye care business. But then you have J&J and Zeiss. They're the expanders. They're looking to diversify and branch out into other areas like cardiovascular devices or microsurgery. It's that classic battle. Do you focus or do you broaden your horizons? It's a really interesting question to think about for the long term.
Okay, so we've been through 2 intense rounds. We've looked at the money, we've looked at the strategy. Now it's time for the judge's decision.
We've laid out all the evidence, right? The revenue dominance, the incredible cash efficiency, the clear technological edge, and that super focused strategy. So who put all the pieces together to take home the 2025 crown?
And the winner, by what I'd call a clear decision, is Alcon. In 2025, they were simply in a class all by themselves.
So why'd they win? Well, according to HDIN Research, the victory was built on 4 key pillars. They had the best capital return in the business, the strongest free cash flow, a whopping $1.7 billion, a major tech advantage in the most profitable slice of the market, and above all else, just superior operational discipline. They just ran their business better than anyone else. But as any champion will tell you, the second you win that title is the second every single challenger starts coming for you. And the landscape for 2026 is already shifting, with some pretty big headwinds on the horizon. And the biggest of those headwinds is something called volume-based purchasing, or VBP. Basically, this is a policy, especially in a massive growth market like China, where the government acts as one single gigantic buyer. And they use that power to negotiate huge bulk discounts. It's a brutal price war that can absolutely crush a company's profit margins. And that is not all. Looking ahead to 2026, every single one of these titans, Alcon included, is facing that margin pressure from VBP, geopolitical risks messing with their supply chains, governments and emerging markets taking forever to pay their bills, and even brand new disruptive business models popping up. For investors, these are all really significant risk factors to keep an eye on. So here's the bottom line. In 2025, the title was won through just being better at the fundamentals, superior operational discipline. But the winner of 2026, that's going to be the company that proves it can adapt and pivot in the face of these huge market shifts. This fight is far from over. Now, if you want to go way deeper on this and get the full round-by-round analysis of all the contenders, the source for this whole explainer is the complete 2025 market report from HDIN Research. It's a great read.
You can download it right now at hdnresearch.com. Thanks so much for tuning in.